Hello guys, what's up? This is Ibad Rahman. Welcome back to my channel Finico. In this video, we're going to cover hedge funds, which is a part and aspect of an alternative investments. And my aim and my obligation, I would say, that by the end of this video, I can give you a proper overview of the list of what I've gone to create about hedge funds, in which I will take my time and go on to explain you all of the 10 criterias, and hopefully that by the end of this video you will have an understanding about what hedge funds really are. Now, before I can go on to explain you about hedge funds, I would first like to take you towards alternative investments, since hedge fund is a part of alternative investments. So that's point number one. Now, alternative investments is any financial asset which can differentiate itself from a traditional asset, from a traditional investment, being the stocks and bonds. Obviously, hedge funds is one part of the alternative investments. However, it is not only. You have got the likes of private equities, venture capital, commodities, real estate, infrastructures such as railways, roads, airports, seaports, telecommunicational lines. All of these are parts of alternative investments. They also include other structures such as investing in modern art, in stamps, in intangible assets such as patents, or as well as having a collection of sophisticated and vintage cars. Anything which could differentiate from the traditional investment per se, being the stocks and bonds, comes under the category of alternative investments. All right, and one of the main reasons of how you can go on to identify and differentiate one financial asset to the other is on the basis of liquidity. Now, stocks and bonds, especially cash, is described as being highly liquid, and one of the forms and aspects of how you can go on to understand through it is you can go on to define a liquid asset if it can go on to turn into cash overnight. Now, how possible would it be if you would have to sell, let's just say, a railway road or a seaport or a modern art, and then you can go on to recoup that amount of money in overnight, in a day? Not very likely, is it? So that is what alternative investments really is. It is an illiquid asset, and at the same time, investing into the alternative investments, you need some sort of a sophistication of knowledge, and as well as having a high liquidity and having an adequate amount of wealth, which I will get into the later part of the video. Now, that's one. The second thing what I would want to speak about is your type of investment and your investors with respect to the hedge funds. Now, you see, the hedge funds managers, they have been given the liberty and the freedom what the traditional managers don't. I mean, they can, let's just say, for example, invest in derivatives such as options, futures, forwards, swaps. They can be highly leveraged and be either long or short of financial assets they require and they need in order to get that very required rate of return. Now, the investors, as I shortly went on to tell you, that not every Tom, Dick and Harry can go to invest in hedge funds. You need the adequate amount of wealth. At the same time, you need to have a high liquidity, and you need to have a sophistication knowledge of the know-hows and how to, in order to differentiate yourself from the other investors. And at the same time, the risk in the hedge funds is quite enormous. One individual need to understand, let's just say, for example, if you invest $1 million, you can actually lose that entire $1 million. However, having said that, that is limited, but that's essentially and certainly a possibility. Okay, then you have got the third, being the prime brokers. Now, the hedge funds, because of the sophistication of the investment what the managers go on to pursue, they go via the prime brokers. And why prime brokers is because the prime brokers goes on to give them custodian services, administrative services, money lending, security lending for trading. And hedge fund managers and prime brokers also come into consensus and grant a covenant over the margin requirement what they will be going to taking. Okay, then we have got the fees. The fourth being the fees. Now the fees in the hedge funds is primarily your 2 by 20, your 2 being your management fee and your 20 being your performance fee. Now what do I mean by management fee and performance fee? Management fee is, let's just say, of the chore and of the work of what they're going to do with respect to your opening of your account, the trading of your assets. I mean the time which they just basically going to spend. That is what your management fee is. The management fee is basically is your 2% of your overall asset under management. Okay. Now you've got your 20% fee is your performance fee. This is something which is not an obligation and does not come on the rocks of what you have to go on to pay the management fee. Your performance fee is only when you go on to pass something known as a hurdle rate. The hurdle rate you can be identified and can be said of is that, let's just say that you go on to surpass a return which is made upon a consensus, a percentage of the asset under management of the profit which had been taken over a year, which for instance is your holding period rate of return, which you go on to identify it as ending value divided by your beginning value minus 1. You convert that into percentage. That will go on to give you the holding period rate of return. In other words, it can also be said as an year-over-year return or the overall asset under management what you have. All right. Now that is something which we say in investment management as a soft hurdle rate. You also have a hard hurdle rate, and in your hard hurdle rate is what you go on to do is that you just do not have to go on to beat the very soft hurdle rate. I mean, that is one of the aspect. Plus you also have to beat a relative benchmark. Let's just say that your benchmark could either be S&P 500, could be Nasdaq 100, could be Nasdaq Composite, could be Dow Jones Industrial Average, could be Euro Stoxx 50, could be CAC 40, could be DAX, could be FTSE 100, could be FTSE All Index, and so on and so forth. So that is what your hard hurdle rate also comes into. All right. And fifth, very closely watched, is your returns. Now your returns, investment managers can go on to provide you, or you can ask the investment managers, the hedge fund managers, providing you the returns on the basis of absolute returns. And absolute returns would be your profit percentage on a yearly basis, or your relative returns, which is on the basis of the benchmark. Let's just say your hard hurdle rate, for example, have you gone on to outperform the benchmark, and by how much percentage have you gone on to outperform the benchmark. Okay. Then you've got your lockup and your notice period. Your lockup and your notice period is something probably you're aware of. Lockup period is something, if let's just say that if I invest in a company for 30 to 60 days, I cannot go on to ask even a percentage, even a penny of that company. I mean, my money invested in that company. That is what a lockup period is. You will not be eligible to get any money until the lockup period, say 30 days, 60 days, or 90 days is passed. Notice period is something you have to notify the investment fund manager, you have to notify the hedge funds in order to give you this much amount of money or the entire money. And well, the notice period is kept across because as you see through that the hedge fund managers are invested in a variety of different financial assets into different geopolitical locations, and for that very reason they need the very time in order to redeem the shares, and redemptions of shares when it comes to hedge funds is absolutely very expensive. So but hedge fund managers can always go on to offset these kind of a cost by taking these very costs from their investors, which in other words is also known as redemption fees. Okay. Then we have the funds of funds. Funds of funds could be identified as, let's just say, any investment funds, any mutual funds who do not have the sophisticated financial knowledge or do not have the investment strategy and methods as what is crucial to the hedge fund managers and what he or she possesses. Investment funds can go to invest into the hedge funds, and the return would be recouped by the investment funds and the investors of the investment funds. Obviously, there is a percentage of fees what the hedge funds will be requiring from the investment funds, but as I told you in just the earlier thing, that the investment funds managers can go on to take that amount of percentage to offset their cost from their very investors. All right, then you've got the benefit and risk. The benefit is clearly that the hedge funds, in terms of long periods, say a decade or more, 2 decades, they have gone on to outperform the equities, outperform the bonds, certainly enough. However, it is in the short-term period is where the big risk comes around. Is because you have a high standard deviation. Is because you have a high variance. Basically, your variance and your standard deviation, if it's more away and far away from the mean, that is when, if it is more and more dangerous would not be the right word, but then definitely it has more risk towards it. You also have in probability distribution something known as a normal distribution. So let's just say that if it is not a normal distribution, if it is say that the very skewness is actually negatively skewed, which basically means your standard deviation is negative, that also goes on to relate and mean that you will go on to have high risk towards your investment. If you also go on to say through that the skewness of the very tail of the standard of the normal distribution, basically the fat of the tail on the either tails being either the leptocotic or the claptocotic, then at that very point of time as well you can go on to have a high risk. So these are again the probability distribution point of view. What I'm basically trying to tell you is that over a long-term horizon, hedge funds have gone on to outperform the equity securities and the bond securities. However, over a short-term period, they have not gone to do it. And at the same time, the other risk towards it is that hedge funds have a very strong correlation with the equities during a downturn, during a bear market, during high uncertainty, during unprecedented, during a bear market, what we are seeing at this very point of time. At that point of time, hedge funds do not go on to outperform the equities. At some cases, they actually go on to underperform the equities. But let's just say that when everything is smooth and sally, at that very point of time, hedge funds actually go on to outperform the equities. We have got due diligence. Now due diligence is one of the aspects of the hedge funds is that they are not as transparent and as regulated as the other financial institutions, not because they just don't want to, because there's no obligation in laws towards, because their very investment streams and investment methods is quite different. Now that is what the due diligence also goes on to play a peculiar part. So if I have to go on to invest into a hedge fund, what is the kind of things which should come to in the back of my mind and I should look towards it? You've got to ask, what is the investment process? What is the investment streams? What is the investment strategy? How can you go on to differentiate yourself from the other hedge funds? Because there are many wealth managers, there are many hedge funds. What is the intrinsic value, what your company possesses that you will go on to outperform your other competitors? What is your longevity? Longevity basically, I mean the period of time you would go on to invest into a particular investment. What is the benchmark you are affiliated to with respect to outperforming the benchmark if you go on to possess the hard hurdle rate? And most importantly is your risk management. How and what are your methods with respect to capital preservation of assets during a down market? Now, these are the 9 important points, but the most important point of the hedge funds of all is your hedge fund strategies. Okay, these very strategies of what hedge fund investors actually go on to take with respect to an investment. So the first strategy is basically your event driven strategy, and what your event driven strategy means is with regards to a corporate restructuring or an acquisition of a company. At that point of time, what you ought to do in merger arbitrage is that you are long, you buy the shares of, or you buy the equities of a company which is being acquired, the target company, because what happens that after the acquisition, the shares of the target company just swaps up, just increases, and you sell short of the shares of the company which is actually acquiring. Okay, then you have distressed. Okay, you have got your distressed investment. Distressed investment basically means that you are buying the shares of the company which are undervalued because of the financial distress what they're going through, but you do believe in the intrinsic value, in the fundamental value. Probably you have done a discounted cash flow approach, probably you have done a capital budgeting with respect to the net present value and the internal rate of return, and you've seen through that, you know what, right now I might actually go on to suffer the pain, but in the years to come, in the period to come, this will reward me, and it will reward me exponentially, is what distress investment is. Now, activist shareholder is one of my favorite points. Activist shareholder is basically when a shareholder of a company goes on to acquire the majority shares of the company, so much so that it can influence the very management decision making of the company. One of the critical example what I would like to give is the activist shareholder Carl Icahn. So Carl Icahn, what he does and what he used to do is that he acquires majority shares of the company, and then when, let's just say that if you go on to possess 60-70% of shares of the company, I mean, hands down, without a shadow of doubt, without a shadow of dark, that you will go on to influence the very management decision of the company. And if by somehow or the other you have able to crack the puzzle, and then you have to go on to find your way from the jigsaw puzzle, you will actually go on to see through that the returns will just not be passed on to the very company, but also be passed on to the company shareholder, and you will go on to profit exponentially. I'm not getting the very date and the share price right, but I guess if I'm not mistaken, Carl Icahn actually went on to invest in Netflix in 2013. He did go on to render with the management decision making, and in 2015 he went out and he had I think so around 370% return. I mean, that is absolutely mammoth when you invest a high amount of money. I'm saying around, if you invest say 300, 400, 500 million, close to $1 billion, I mean, this is, I mean, exponential return what you can go on to do. Obviously, if things goes north, if things go south, well, things are just bad and ugly then from there. Okay, then you have relative value strategies. All right, this is the second point, being after the A, B, and C. The relative value strategy means that you are having a simultaneous, okay, at the same time position of a long and a short position in a respective security. So what do I mean by it? One of the common examples being your convertible arbitrage FI, which is your fixed income. Have you actually heard of the convertible bonds? Convertible bonds is something which you can go on to convert into equities in a period of time when you feel that it is the right moment in order to convert it back to equity. So what you're going to do is that you're going to, let's just say long, you're going to buy the convertible bonds and you short the very shares of the issuing company, and you profit when the price discrepancy between the convertible bonds and the issuing share equity goes on to resolve. When the price discrepancy resolves, that is when you profit. Okay, the same philosophy follows to the asset-backed fixed income, and the asset-backed fixed income where you have the ABS, which is your asset-backed security. You also have the MBS, which is your mortgage-backed security, and again, you're either short one of the asset-backed securities and you're long the other asset-backed securities. When the price discrepancy gets resolved, you go on to make a profit. The same follows for your general fixed income, which is your different kinds of fixed income. You can say, for example, collateralized debt obligation, the CDO, or CMOs, the collateralized mortgage obligation. Again, you're basically buying one of the CMOs and you're shorting the other CMOs, and then you make the difference. It can also, that's the reason why it's arbitrage, because you're arbitrage trading. You are profiting from the price discrepancy. All right, then you have got volatility. Volatility means that you go on to profit from the current share price return of the option prices with respect to the futures management rate of return of the volatility what the manager goes on to possess and will be done in the future time. So if the volatility of the current volatility of the options and the future volatility of the option, if the price discrepancy gets resolved, you go on to make a profit. Third point being macro strategy, and macro strategy has to deal with the economic events, the economic trends, the geopolitics situations and tensions, what we're seeing at this point of time between the Ukraine and Russia, but just not the Ukraine and Russia, but between Russia and NATO. I mean, what the kind of a position are you really going on to take? I mean, do you short currencies or do you long currencies? And by the way, individuals who had actually been short rubles before 24th Feb 2022, when Russia had actually gone on to attack and invade Ukraine, they made immense amount of money. Because I mean, the secret of short selling is something which is absolutely very risky, but at the same time can give you exponential return. Is you profit when the price of the security or when the price of financial asset goes down, you profit, your return goes on to multiply. Okay, then we have the equity hedge fund strategy. Now, the equity hedge fund strategy is that you either have the long or a short position in an equity or derivatives, say options, futures, forwards, but the underlying value of the asset needs to be an equity. The first point being the market neutral. And what happens in market neutral is that when you have a long position in one security and you have a short position in the other security, and you do that by having a fundamental analysis. And having a fundamental analysis is basically you go through the financial statements of the company, you go through the income statement, you go through the balance sheet, you go through the cash flows, you look at the indicators such as what is the P by E, what is your price by earning per share, what is your EPS, what's your earning per share, what is your enterprise value by sales. And enterprise value, in my opinion, is actually much more important than the market capitalization, and is a proper way to value a company rather than the typical market cap, for the very reason being is your enterprise value, if I have the space, if your enterprise value is equals to your market cap, okay, your market cap plus debt minus cash. All right, so this basically goes on to tell you, I mean, this is the overall value of the company, but market cap is only your share price into your total number of shares outstanding. Why I always choose enterprise value if I'm doing my own fundamental analysis of the company? Because it includes the market cap, but at the same time it includes the debt, the long-term and the short-term debt, the total debt, and as well as I will go on to subtract the amount of cash. So again, I'm sorry to digressing, but I just wanted to point out how enterprise value is so important when it comes to fundamental analysis. Now, you can also go to use your technical analysis in order to make a long or a short trading with respect to your oscillators being your moving average, convergence, divergence, being your rate of change oscillators, being your stochastic oscillators, being your relative strength index. If you want to come out of the oscillators, you have the EMA, which is your exponential moving average, or you have the SMA, which is your short-term moving average. You could see through, well, is there a golden cross happening or is there a dead cross happening? Basically, a golden cross is when you see through that your short-term, let's say your short-term exponential moving average, which is your 20, has actually crossed over the other exponential moving average, which is your 200, which is the 250 trading days, actually 250 trading days in a year. When it actually has crossed, that basically goes on to signify that the shares of this very security, of this very company, will actually go to increase. And obviously the dead cross is the vice versa. All right, and market neutrality basically means that you are having an equal position in shorting and equal position in longing, because you are absolutely not sure what will happen during an uncertain period of time. So you would want to be safe. For instance, right now, because of the high volatility, you are seeing that the global shares are actually rising on a relative basis to what it was 3 weeks back, because 3 weeks back it was a bloodbath. At that point of time, when you had actually shorted the S&P 500 and Euro Stocks 50, you're actually going to make a hell and a good amount of money. All right. Then we come towards the fundamental growth and value. Now you have done your capital budgeting, you have done your discounted cash flow, you really think about just not the storyline of the company, but you've seen through the financial statements and you've seen through, okay, well, you know what, just because of the financial statements being poor at this point of time, but actually the market research and the product is so strong and the philosophy of the company is in conjunction towards it, I really believe that this company will actually going to do very well. I mean, when SoftBank went on to invest in Alibaba back in the early 2000 2001, Alibaba was an absolutely teeny tiny firm, e-commerce firm, and what and how Jack Ma went on to sell that idea to the SoftBank shareholders is just by his storyline and what he wanted to do, and as well as backed up just not by the storyline, but as well as the products and the methods of how he wanted to contribute to just not the Chinese economy and the global economy. And Alibaba from then and since then has done on to do extraordinarily well. Obviously from 2021, quarter two of 2021, things has gone south, but there's definitely a reason behind it, which I'm sure you're already aware of. Okay, then you have your quantitative directional. Quantitative directional is when you're solely using your technical analysis. Like I've said, I also forgot to use the term of Bollinger Bands. Bollinger Bands is also very great. This is basically your standard deviation of both of your Bollinger Bands, and you can go on to relate, or when you have to sell your shares and then you have to go on to buy your shares. You can also go on to use your polarity between your resistance and your support level in order to make investments. And at the same time, you have many of the other technical patterns, such as your bullish rectangle or your bearish rectangle or your bullish triangle and your bearish triangle, and then you have your pattern, which is your continuation flow methods. So you're going to place your deck on the cards, your cards on the deck, sorry, by having a long or a short positions in these very investments. So this is a quick overview of the hedge funds. I hope, and I really hope, and I wish that I was able to give you a quick bite about what hedge funds are. Hedge funds, again, is a great investment strategy to actually be into a person's portfolio. However, having said that, if it does come with the return, it also comes with the risk. Again, thank you so much for being such a hospitable audience of watching this video until the end. Please do not forget to like, share, subscribe, but most importantly, comment if there's anything what you do not understand, or there's something what I can help you with in order to amplify your hedge fund aspect knowledge in this. I will be more than willing to be at your disposal. Thank you so much, and I wish you guys a great day, a great journey lies ahead. Thank you.